Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Thursday. It's February 3rd. It's about 7:54 in the morning. Market's going to open up in about an hour and 35, 36 minutes or so. As you can see here, the Dow's down only 29, but the NASDAQ is down almost 300 points. That's right, almost 300 points. It's not a mistake. And the S&P's down in between. Now, the big reason why the NASDAQ is down so much is because Meta platform, Facebook, is down almost 23%. The stock is down $71. And I think it's a little bit of an overreaction. The stock missed earnings estimates, as I'll talk about right now. But we're going to get a lot of volatility today from the indexes. Other stocks like Xilinx, let's see here. I think some chip stocks are down. Let's look at AMD. AMD's a little weaker. The bottom line is we could see some turmoil in the NASDAQ 100 today. Now, it's already pricing in most of the downside right now. It's down almost 2% and completely undid everything it did the last 2 days. But I'm hoping that this is a major overreaction in the NASDAQ 100 and that prices will go higher today. So I'm expecting most of the downside in Meta to be priced in because, look, the stock is down 22%. I don't think earnings were bad enough to justify a downside of that much. I think the market is overreacting. The Dow, on the other hand, if we look at the Dow, which we will right now, we will see here that the Dow Jones is actually now 2 days above the 200-day moving average and is now tipping its hand at the 50-day moving average and is looking pretty good. It's only down 0.33, which I can imagine if the NASDAQ wasn't pulling the S&P down and the S&P is pulling the Dow down because the S&P has some Dow stocks, the Dow would be even higher than it is right now, which is really bullish. Now, we got out of the Dow yesterday at the end of the day in anticipation that Facebook earnings were going to be weaker than expected. But I wouldn't mind getting back in because the strength is definitely there in the Dow Jones right now. Now, volatility started picking up just a hair, and I mean just a hair. I wouldn't make too much out of this Meta earnings unless it spills into the broad market, and I'm not sure it will. Bond market is still stable, still within its trading range, and I'm expecting this trading range to continue till we get a little more clarification from the Fed on whether or not they're going to be raising rates or not. Put the call ratio still near 97. It's showing 85 here, but it's really at 97, and 97 is near 1, and anything above 1 is telling us that the market still has more upside to go. So I'm going to assume, and this is looking at the S&P, I'm going to make the assumption that this current price level is pricing in the low of the day and that Facebook is down more than it's going to be for the remainder of the day. I think this is an overreaction, a big overreaction. I mean, look, this stock is going to open right here. I mean, is it really going to go lower from here? This is like a base of the price. Like, look at this. This is where the stock was, let's see here, back about a year ago. So this is completely undoing everything the stock has built over a year, and I think it's an overreaction. And I actually think the market's going to close a lot better than its opening, in my opinion. What the hell do I know, right? Let's look at economy. So today we've got job cut report. We've got jobless claims. That's going to be the big one, especially, excuse me, in light of the fact that these numbers have been picking up in COVID, and the private report leading into tomorrow's employment report was not all that pretty. Then we have productivity and costs. What's great is these reports are all coming out before the opening bell. And then we have the PMI composite, and then we have the Senate hearing. Oh boy. Also, factory orders, very important, and ISM service index. This is going to give us a good understanding of how factories and manufacturing and industrial stocks are doing. That's coming out later today. Now, looking at each individual sector, I wanted to kind of give you an idea because today is Thursday, and Thursday we cover the top ETF and a top option. Energies are looking really strong, but I think we're going to top out a little bit, and I think a lot of the market cap from energies is actually going to go into consumer staples. I think energies are near the, I think energy is going to go up to, I think crude oil is going to go up to about $100. It's about 90 right now, $89 or $90 a barrel, somewhere in that ballpark. And I think it's got about 10% left. So I don't think we have all that much to go on the energy market unless there's something unforeseeable or OPEC starts making greater conditions than they already are. Consumer staples I like right now, and I think we're going to see more upside. Financials I like right now. I think we're going to see some upside. Technology, not today. Definitely not today. Maybe hard tech separated, anything not related to social media, maybe cloud stocks. But I'm still liking, but I'd like to see us go above the 170 level on this sector. Utilities are cooling off a little bit because the market's been strong, but watch out. They're going to heat up once again. Basic materials, I'm expecting us to hit 90 very, very soon. Healthcare is starting to move up. Healthcare is not really impacted too much by this. Industrial stocks and basic materials. These are the two sectors I'm really, really paying attention to. And also consumer staples is a big one. Consumer discretionary, I think, is going to take a dip today. And I think we're going to go back down because I'm just not seeing the influx of earnings to make consumer discretionary all that much better. And remember, consumer discretionary has a lot of tech in it. So both consumer discretionary and tech may be pulled down. Real estate, not really here or there, just kind of on the wait and see. And communication sectors, that's also related to tech and consumer discretionary. So be very, very cautious on consumer discretionary today, on the communication sector today, and on the technology sector today, although technology is looking pretty bullish. But in light of what we're seeing on Meta, let's look at how tech is really looking today. Let's take a look here. Ooh, ouch, look at that. Yeah, it's going to open up down here. So we're going to have some volatility. What I'm hoping is that we're going to be opening near the low end of the range, and we're actually going to go higher today. I'm just not seeing one stock or two stocks have massive impact. But we have been going up pretty good the last few days, and momentum is strong, and I'd love to see us stay above the 200-day moving average. So what I'm hoping for is, I'm hoping that this gap is the low, and then we're going to fill in the gap towards today's or during today's session. Again, volatility is not that high. Put to call ratio is relatively stable. Let's look at global economy, and I'll highlight all the factors we need to pay attention to. U.S. futures were lower as investors watched for updates on monetary policy from Bank of England and Europe, mindful of the Federal Reserve's plans to raise rates in March. I don't think they're going to do anything later today or tomorrow, but maybe in March. Maybe. We'll see how the market's tuning. Bank of England was expected to raise interest rates again Thursday, putting the United Kingdom far ahead of the rest of Europe and the U.S. in moving to tame surging inflation that is squeezing consumers and businesses. Investors have been reviewing the latest corporate round of corporate earnings to gauge the damage that rising costs on different industries and consider how companies will deal with inflation moving forward. So far, earnings have been actually better than expected on most of the companies. Most companies have reported results for the last 3 months, have delivered earnings and revenue that topped forecast, despite the higher costs they face due to rising inflation. And folks, it's always earnings versus interest rates, earnings versus interest rates. And so far, they're doing better. But here's where the problem lies. Facebook parent company Meta Platforms saw its price share plunge 22.9%. We spent a few minutes talking about this. And after hours trading after its latest quarterly earnings did not meet Wall Street estimates. I mean, I'm going to take a look at what they were in a minute from now, but they got to be bad. Oil prices fell after major oil-produced countries decided Wednesday to stick with their plan to just a bit more oil to the global economy. That will likely keep prices near the highest levels in 7 years, and I'm expecting oil to stay near the current levels, but I don't think there's that much more upside in the broad scheme of things because crude is already near $100 a barrel. The 23-member OPEC alliance opted to add 400,000 barrels per day in March. Not a whole lot. 400,000 barrels a day is not a lot. Markets are facing various threats, including rising inflation, prospect of higher rates, potential conflict in Ukraine, and COVID's continued drag on economic recoveries. I think that summarizes it really well. With inflation at a 40-year high, rising costs are threatening profit margins and putting pressure on consumer spending, which is why I believe consumer discretionary is the weakest sector right now. The Federal Reserve intends to raise rates to try to tamp down price increases. Investors expect the first rate hike in March and 3 more in 2022. Folks, don't hold your breath. The Fed always overshoots, which is why the bond market right now is very, very choppy. Now let's take a look at those Facebook earnings. I'm actually very curious myself. Let's look at the news on this company. Let's see here. Here we go. Here we go. Let's see if there's a... Here we go. Reported quarter since changing company name from Facebook. Maybe they should have left it Facebook. Missed bottom line, $3.67 per share versus $3.78 expected. Joined a beat on the top, 33 versus 33. They barely beat it. Biggest reason the stock is down, whopping 23%, is the weak revenue guidance. Got it. Going forward. Got it. 27 to 29. So that's the reason why. Okay. Understood. I wanted to understand exactly why. The numbers aren't that bad. It's the future guidance. But I don't think that justifies taking price down 22%. Now, let's talk about the strongest sector. And you're not going to be surprised, but the strongest sector right now, it still remains the energy sector. And I'm going to do something a little different today because I actually like consumer staples more than the energy sector. It's the second strongest sector. I think energy may be just a little bit toppy right now, so I'll go with consumer staples. And if we go with consumer staples, let's do that right here. I like consumer staples. I think we're going to hit highs soon. I would go with, I'd go all the way to June. Let's see, January, February, March, April, May, June. And I would go with, I wouldn't go too far out of the money. I'd go to the 76s right here. Look at the open interest and liquidity. Yeah, I mean, this is fine. Don't go 77. Stick with the money. 76s, nice juicy premium, or maybe even the 75s. I like these right here. Somewhere between 75, 76. Premium is really good, and these things can rise quite a bit. Implied volatility is really high compared to historic volatility, which is why I want you guys to go in the money, because you're going to have less implied volatility because there's more price, there's more intrinsic value here than time value, and time value is what causes the implied to rise. So when I see high implied volatility compared to historic, it's typically smart to go in the money, which is why I like the 75s in this case, or 76s. All right, now, before I let you go, I have something very, very, very important for you. And again, I think we're going to see some choppiness. I think we're going to see a little sell-off in consumer discretionary. But overall, I think the market's overreacting right now with Facebook being, or Meta being down 22% on forward-looking guidance. So I think the market will trend higher, but we may have a rocky bottom. It'll be very interesting to see how we close today. Don't pay attention too much to the opening. Pay a lot of attention to the closing. I think that's going to give us some clues into how the market's really interpreting the Facebook earnings. Now, I got something important, crucial, timely, and something I want you guys to pay very, very close attention to. Jeff Zananeri, the guy's been on fire. I mean, the guy has been on fire lately. Hedge funds, large institutions, they test out new stocks they want to add to their portfolios at the start of each month. That's exactly what they do. They're moving mountains of cash into new stocks, buying in chunks to test price sensitivity. I do this all the time. I actually have a course on this that I do myself. But Jeff actually figured out the rhythm that I wasn't able to in this regard, and he got it down to a science. As they enter, the stocks are poised to gain momentum through the rest of the month. So when these stocks pop, when these moves occur, joy of the trade, head trader Jeff Zananeri scanner, oh boy, when they make it on his hot list, he rides these plays all the way to the end of the month for gains like 105%, 201%, heck, even 423%. You've got to click on the link below to get the latest money flows for just $5. Jeff has been able to figure out exactly what makes hedge funds move stocks and how much. I love this. I've been trying to figure this specific tactic out for a long time, and he brought in two pieces that I was completely missing, and I love it. I love it, love it, love it. This is going to improve my trading, and I'm sure it'll improve your trading. Click on the link below to get the latest money flows for just $5. Follow the link below. You cannot afford to miss this out. $5 a month. This is a similar strategy to one of mine, but Jeff does it in a way that takes into account timing of the month and a specific range of price. You are going to love this. If to spend $5 to learn this strategy is like somebody giving you something worth a lot of money for free, in my opinion. This is good stuff. This is something you want to add to your toolbox. Even if you don't use his signals, which are amazing, just understanding the system behind it is so important because it can improve your trading, and you can add a little couple of filters that he does here. It'll change how you trade. But for $5 a month, this is just the biggest no-brainer ever. Check this out. Follow this now. And tomorrow, we're going to talk about weekly recap, biggest winners, biggest losers, what to expect next week. You don't want to miss out. But I'm very excited about Jeff doing this for you guys because Jeff has been on fire, and that's because he managed hedge funds. He traded institutional money, and he's going to teach you how to do the same thing for your account, which is really, really great. I've been doing this for almost 30 years, and I listen to what Jeff does, and I mean, it's awesome stuff. If it's good enough for me, it should be good enough for you. Follow the link below, check it out, do it now, and I'll talk to you guys tomorrow. It's Friday Eve, isn't it? Bye, guys. And if you guys are enjoying this, send me an email, support@marketgeeks.com. You guys want me to cover something? Support@marketgeeks.com. Bye, and have a great Thursday.